Welcome to this video on stock trading. I'm going to share with you a few of the very basic structural parts of technical analysis when you're trading stocks. So here's an example of Disney, and what I have on here are 4 moving averages. So especially on daily, weekly, and monthly charts, I highly recommend these 4 moving averages, and they are the 15 exponential moving average, that's the black one here, the 50 simple moving average, the 100 simple moving average, and the 200 simple moving average. So especially these last 3, they have a self-fulfilling prophecy. So many people use them that I highly recommend them, especially when, like I said, you're in daily, as we are here, or weekly or monthly charts. Now, when you get down to intraday charts, they're not quite as reliable because you don't have that mass psychology of the masses using the same moving averages, but here you do. And on the short one, it's important to have a short-term moving average as well. I like the 15 EMA. Some people do like the 9 or the 20. That's fine. For me, I prefer the 15. Now, what this does, it provides structure. So, first of all, they are dynamic support resistance levels. Dynamic meaning that they change over time. So, for example, right now, you can see the red highlight here. The 50 MA is at 124.33 for Disney, but over time, it's been down here to 105. So the level, the price it's at is different, changes. So if you look back here, for example, we see that we have, this is what I call the pinball pattern, where prices will get in between the moving averages. And see how they all clustered together there? And then the market gets stuck and the stock just trades in between them for a while. And then, of course, we had the big nosedive here in February. So this is part of the structure that I look for. I don't like to trade when price bars are stuck in between the moving averages and they're clustered in there. That's part of a choppy market condition. So if you're looking at, well, how do I determine if the market is choppy or not? That's one of the structures I look for. I don't like to trade inside those moving averages. Now, when they're close together especially, so that's the 2 things. Number 1, price bars are in between the moving averages and the moving averages are close together. Now, when they're further apart, it's a little different because we can still make some good money here. So, but look at how reliable this is. So price gets from the 15 EMA, goes above the 50, comes back down into it, tests it a couple of times. Where's it go? Goes to the 100. Gaps over the 100 moving average, comes back right down to the cluster of the 100 and the 15. Where's it go? Where's the next high? The next high is the 200. And so there you go again, back down to the 100, 15, the 50, and it's all just playing around in here. Now understand, sometimes people think support resistance are lines. They are not lines. They look like lines on your chart, and actually they are lines. The moving averages are lines on your charts. But in the real dynamic of the bid-ask auction place of the market is a little noisier. You can't expect it that it's going to go right to the pixel on your monitor. That's just unrealistic. So you could say here, for example, that the price bar held the 50 MA as support, but the low of that bar is below it. And you got to give it some of that play. So right here, again, it does get below the 50 and the 100, but pops right back above them. And the way I look at it is to give it some play, or I call them zones. Support resistance levels are zones. We had this bar here that was touching the 50 MA, and all these bars are still the high. These bars didn't break the low of that bar. So we never really got below the value of that bar in a convincing manner and came back above. Come back, hug the 15 and the 50. And then when we go up and we gap above the 200. So there's structure again. When the market gaps up, it gaps above the 200, comes back, retraces to the 15. And that's how I use the 15 EMA as a short retrace or a weak retrace. Goes back up. Now, one of the big things here is that you got to know how to time. So just because you have a structure as caused by the moving averages, as we're talking about today, this is the key issue, when is it going to bounce off of the 50 MA or the 100 MA or the 200 MA or whatever? And that's the issue of timing. So timing, you have to have some sort of timing indicator. And that's not our topic today, but I'll tell you what, I'll give you a, there's the link right there, link to a free recording that I've done where I actually share with you the indicator that I use for timing my entries with precision. And well, it's one of the best things I've got, and I just give it away for free. So I'll show you how to get it set up in your charts and so forth. Just go to indicatorwebinar.com. It's a recording now. Used to do it live. Now I'm doing it as just a free recording to my online free students, meaning you. Now, the other thing I had that creates structure are these horizontal lines. So what are these? These are levels of previous highs and lows. Okay, and you can do these at different scale. That's up to you. But obviously, this low stands out dramatically. This low, okay, we got that one. We got this high. And notice now, we got a convergence when the market gaps up above the 200, comes back to the 15 EMA, and that high as support. So that provides extra support there, and that's because you got the 15 EMA. Some people are looking at that, and a lot of people are going to see that high. And so the more people you have looking at a support resistance level, the more likely it is to hold. Again, nothing magical about it whatsoever. There's nothing magical about the markets. It's all bid, ask, supply, demand. And the more people who see something, the more they're likely to buy off of it, sell off of it, or take profits into it. Just the mass dynamic. So when you get a cluster like that of support, in this case, the moving average and the previous high, higher probability. All right, and by the way, look, where did we go? We went right up to here. Well, where did that line come from? Well, let's go back, go all the way back to that low. That's the low that level went into the future. Notice, by the way, again, gapped through it. You will see quite often when the market does get above or below these support resistance levels, especially if they're significant ones, they will gap through them the next day if it's a strong market. And that's what happened. Boom, we just gapped right through that one. And then, so that's support. That becomes resistance over here. Let me see if I can get all of that. I'll change my scaling here for you. There we go. So that's what they mean by support becomes resistance. And now what are we doing? We're just playing around here. Disney, Goofy, and Mickey Mouse, they're just playing around between these two levels. All right. And this is where now other things we would need to add to the chart would be momentum and cycle, timing indicator already mentioned. And momentum is what helps you find out whether the market is going to really make a big move or not. And of course, volume is part of that. But volume, ironically, doesn't work the way most people think it does. And I think I'll do a separate video on that because our 10 minutes is almost up here. So anyway, that's price structure, where we're using moving averages and horizontal previous support resistance to look for levels in the future for buying, selling, or taking profits. So that's it, my friends. Now, I got a free trade strategy for you that you can get absolutely free by going to rubberbandtrade.com. That's it, rubberbandtrade.com. Put it up there for you. And it is free. It's an entire structure of, it's a structural trade like this, and we use the 50-period simple moving average for it, and it's reversion to the mean mathematical model. So this is actually a great video to watch before you watch the rubber band trade video, and because now you understand how I read structure with moving averages, that's exactly what we do for this very specific trade called the rubber band trade. So go ahead and get that one. I'll give it to you for free, and along with all the rules. We talk about the entry, the exit, the targets, all of that stuff, all the rules, my gift to you. So take and enjoy, and happy trades.